In this video, we are going to talk about dividend stocks to buy and hold forever. So before starting this video, please like this video and subscribe to this channel for our future updates. In the year 2022, it is simple to get swept up in the frenetic headlines that are surrounding the stock market. However, mountains of research on investments show that the best way for you to profit on Wall Street is to take a long-term approach that involves buying and holding positions rather than churning your positions and giving yourself heartburn in the process. Taking this approach involves buying and holding stocks rather than buying and selling. If you take any day since the Great Depression and add 20 years to it, the market is always higher than it was before you picked that day, according to study. This means that stock prices are almost certain to rise in the very long term. Consider purchasing and keeping onto these stocks for the rest of your life if you are an investor who is in no way close to reaching retirement age. Abbvie Incorporated, ticker ABBV. Despite the fact that it has been a difficult year overall on Wall Street, this pharmaceutical stock is one of the few firms that has managed to post a profit so far in 2022. But in addition to that, it provides a consistent dividend return that is quite significant. In point of fact, if you go beyond Abbvie's 2013 spin-off all the way back to its beginnings as a subsidiary of Abbott Laboratories, ABT, you will find that the company has raised its dividends for at least 25 years in a row. People will continue to spend money on medical care regardless of the state of the economy as a whole, making the healthcare sector an extremely stable and reliable industry. In addition, ABBV has a solid research pipeline in addition to the blockbuster anti-inflammatory medicine Humira, so the company has a lot to offer investors who are looking for long-term income. Altria Group Incorporated, MO. Given the well-known health hazards associated with smoking, you might believe that investing in one of the largest tobacco companies in the world is not a particularly astute long-term strategy. But MO has been producing brands like Marlboro cigarettes, Black & Amp, mild pipe and cigar products, and smokeless tobacco like Copenhagen and Skoal for decades, and it has made its investors a significant amount of money despite the fact that these products pose a significant risk to the consumer's health. This Virginia company can trace its roots back almost 200 years, and it is exceptionally well run. It has an enviable history of more than 50 dividend increases over the previous 50 years, which demonstrates its dedication to shareholders and its potential for long-term income. And looking to the future, the corporation is expanding its product offerings beyond tobacco by making investments in businesses related to the legalization of marijuana as well as in Juul vaping goods. These moves are being made to secure the company's sustained prosperity in the years to come. Amp, T Incorporated, T. Amp, T, an industry classic in the field of telecommunications, has had somewhat of an unusual year due to the recent separation of Warner Bros. Discovery Incorporated, WBD, which decreased both the market value of parent Amp, T as well as its dividend distribution. This information has either perplexed or discouraged a number of investors, but in the long run, it is an indication that the company is shifting its attention to what it does best, which is data connectivity rather than media and content. A new quarterly dividend of around 28 cents per share will result in a yield that is more than 4 times that of the typical Amp wink with tongue sticking out 500 component when calculated annually. The huge moat that surrounds Amp, T, combined with a payout such as that and an established domestic telecom network, makes it virtually assured that those dividends will continue to pour in for many years to come. Cardinal Health Incorporated, CAH. Cardinal is not your usual mega-cap insurer or pharmaceuticals business, rather, it is an integrated healthcare organization. Cardinal's focus is on patient care. In its place, CAH provides goods and services to a variety of establishments, such as medical offices, surgical centers, and nursing homes. This includes the provision of medical supplies, lab items, personal protective equipment, bandages, and other needs that may not have enormous profit margins but unquestionably satisfy an enormous need. Because of this $15 billion healthcare player has been able to maintain a steady revenue stream, which has resulted in 35 years' worth of straight dividend increases. CAH is a stock that is well worth purchasing and keeping for the foreseeable future due to the company's extensive partnerships with healthcare facilities and its business model, which does not run the risk of being disrupted by treatments or technologies of the next generation. Dominion Energy Incorporated, D. With a market value that is currently greater than $69 billion, Dominion is currently one of the most valuable stocks that are associated with the utility industry. The company generates and sells electricity to over 7 million customers located in the states of Virginia and North Carolina. A legalized monopoly exists in many of the locations that it services, making it extremely stable, as is the case with the majority of utility stocks. However, Dominion is also expanding, with forecasts of a 14% increase in income for this fiscal year and a plan to spend $37 billion on capital expenditures over the next 5 years to ensure that it is transitioning into more sustainable sources of energy such as solar and wind. This is a dividend stock that can be relied on for the long haul because it offers a nice income and has a business plan that is quite reliable. Kraft Heinz Company, KHC. Several years ago, after a bloated mega merger that was immediately followed by an accounting scandal, Kraft Heinz was essentially written off as a company. But now that the dust has settled, with management focusing on the financials while they pay down debt and recover the confidence of Wall Street, this consumer goods behemoth is one that is worth purchasing and keeping for the long term. This company has a loyal following among shoppers and the kind of quality consumer staples in its brand portfolio that will sell regardless of larger trends in consumer spending, such as Heinz ketchup and Kraft macaroni and cheese. These products are found in grocery aisle mainstays like Kraft macaroni and cheese and Heinz ketchup. The packaged goods major is up more over 7% in 2022 as of May 27 as proof of its durability in difficult times, and that makes it a formidable stock to maintain in long-term portfolios. The dividends are not included in the growth of the company's stock. Morgan Stanley, MS. Morgan Stanley is in the sweet spot of the financial sector since it not only offers a tremendous dividend of more than 3% but also offers a massive size that cannot be matched by specialty companies or smaller banks. This puts Morgan Stanley in the ideal position. At a market value of $150 billion and with estimates for $10 trillion in total assets under management in the not-too-distant future, MS is one of the most recognizable and well-known asset managers in the entire globe. This bank, which is almost a century old and has weathered a wide variety of political and economic crises, unquestionably possesses the staying ability to be worthy of consideration as a long-term investment in the financial sector and should not be ignored in this regard. The ONEOK Company. In light of the long-term issues posed by climate change as well as the short-term volatility we're witnessing in commodity prices, it's difficult to have a lot of faith in the stock market for energy companies. But ONEOK, which is a play on the midstream segment of the energy company, is about as sure of a thing as you'll find in this area since it's a play on the energy business. This part of the business deals with transportation and storage, and therefore is not vulnerable to the risks associated with the volatility of commodity prices. ONEOK facilitates the movement of natural gas across the United States, for which it charges fees, and then distributes a percentage of the revenue it receives from those payments to its shareholders. Income investors will find comfort in this stable strategy, which provides significant cash flows regardless of the price of oil over the next year or even over the next decade. This stability will provide investors with the opportunity to generate consistent returns regardless of the price of oil. Vornado Real Estate Trust, VNO. Office real estate operator Vornado is worth a look despite the fact that it is possibly not as well known as some of the other stocks on this list. This is because every long-term portfolio should have some element of real estate in it for the purpose of diversification as well as the potential income it can generate. The majority of VNO's holdings are located in major metropolitan areas across the country, including premium real estate in major cities such as New York City, Chicago, and San Francisco. Additionally, when it comes to the design of environmentally friendly buildings, Vornado is the industry leader. The company's portfolio includes approximately 23 million square feet of buildings that have been awarded the LEED, Leadership in Energy and Environmental Design, certification. Even while the pandemic did cause some disruptions in the workplace and contributed to the expansion of the trend toward working from home, VNO is less likely to be affected by disruptions in the years to come than other players because of its desirable locations and best-in-class properties. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.